Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back for another episode of the 360 Money Matters podcast.
That's right, Andrew. Another episode of the 360 Money Matters podcast.
I was just about to say, that's a tongue twister. Say that 5 times quickly.
Another market wrap.
Exactly right. Another market wrap.
That's it. No, you're right. It is a tongue twister. I'm not going to try it because I already slightly botched it up, but hey, probably a good indication for us to get straight into it. Andrew, lead us in. Where are we starting?
Yeah, so starting where we normally start, we are looking at some of the data coming out of the US, and starting where the topic has been for the last probably year and a half, and it's all about inflation. And what we did see coming out of the US was inflation data came back actually softer than what the market expected. Headline inflation declined down to 3.2%. Which was some very positive news for markets.
Yep. Yeah. Look, America, seems to set the tone. World's biggest economy. We in Australia tend to follow quite closely in terms of what America does and following their lead. So that's a really solid and positive result that the measures that the Fed are taking over there seem to be working and washing through the economy. And just some commentary from the Fed talking about the rate hiking cycle that they're starting to include in their rhetoric, that they think that they're done, and potentially that the risk is that we may be seeing rate cuts if the economy sort of slows down too much. So it's a matter of getting that balancing act right and trying to slow down the economy in order to bring inflation under control, while not slowing it down too much where it stalls, where you then need to do something else with the interest rate lever, i.e. moving them down in order to stimulate it again, because then it's like, you're turning on and off the hot and cold tap in order to try and get something that's warm.
Yeah, exactly right. And it's just one of those things that we were talking about it at the start of this, and probably in every episode of the podcast that we've talked about a market wrap is just how narrow the path is to be able to bring inflation down and keep an economy on even keel. But it seems like that scenario is more and more likely. And it doesn't mean that there's no risk out there, and it doesn't mean that, a recession is not likely to happen or anything like that. But it just means that there's less risk than when we were sort of talking about this maybe 12 months ago when we're at the start of this cycle.
We're talking soft landing, shorter runway, talking sponsorship from an airline.
Exactly right, Bills. Exactly right.
Interestingly enough, with the Fed, we're starting to see commentary about rate cuts. And they're talking potentially 4 rate cuts in 2024. So, what we were sort of describing before about getting that balance right between too hot, too cold, potentially that would indicate that, hey, they think that they may need to do something else in order to boost it a little bit as well. And it's not an absolute science where you move the interest rate lever here and it actually translates to something over there, to a specific outcome. It does take time. It washes through. It's people's behavior. So it is really difficult to try and get this balance in this mix right.
Yeah. And obviously that's a signal for what happens to the Australian economy, to Australian interest rates, which we'll touch on later. But I think just knowing, where the majority of people sit in Australia, debt levels, and even, what we're talking about with our clients, talking about 4 cuts in 2024, and whether that's the same in Australia or less or none, it's probably welcome news for a lot of Australians with mortgages. I know that cash flow's been a big talking point, and potential rate cuts are, obviously really gonna help that.
Just to clarify that's
in the US.
That's in the US. The market is predicting or pricing in that there's going to be 4 rate cuts in the US. But just to clarify, that's not in Australia, but thinking that we take our lead from the US, then maybe that's the way that we're potentially going to go as well too. But just to clarify, that was the US.
That was the US that's pricing.
Yep.
Yeah, of course. And some spending data also came out, Bills.
Yeah, so one of the really big things with inflation is driven by consumers as well too, in terms of our consumption.
Yep.
So one of the things with, increasing or higher interest rates is essentially it takes money out of your pocket, so you have less to spend. So the less you spend, the lower inflation becomes, and then things start to normalize. But interestingly enough, consumer spending in Q4 has softened. Headline sales were down month on month of 0.1%. So lower than expected. The consensus was that the decline would be 0.3, and we are down from 0.9 from the September month. So yeah, it's
so market was expecting a softer sales.
Yep.
And it was slightly, more buoyant than what the market expected, but still declining nonetheless.
Yep.
Which is indicating in the fact that, consumer spending is slowing down, but at the same time, just not at the rate that probably what the market was expecting. Which is interesting at this time of year as well.
Well, that's what I was describing before. It's like you can't do one thing and the results and the impact is immediate.
Yeah.
And there's a whole range of different reasons why that could be the case. We are heading into the festive season where consumer spending does increase naturally with Christmas and gifts and travel. So yeah, it has come down, but not as fast as expected.
Yeah, absolutely right. And markets really reacted, very positively to all of that, all of those news points. And the S&P 500 was up, 8.05% in the last month, which is just ridiculous.
The reason why that's ridiculous is that's akin to an annual rate of return that you'd expect, a little bit higher if we look at long-term averages with the S&P, but that's 8% in 1 month.
That's more than 100% return in a year.
Yeah.
Which is, look, the market doesn't move like that. It doesn't move as evenly as, the same amount each and every single month. But, an 8% movement in a month is massive. Look, the month is not out yet, but I was seeing an interesting chart in that the share market returns, and this was again looking at the S&P 500, and it was looking at a 20-year time horizon, and breaking it down into a monthly return over a 20-year horizon. If you actually historically look at the months of October and November, they tend to be the best months from a share market perspective. And I'm wondering whether that has something to do with the lead up in consumer spending in anticipation for December. It was, it's only further proving that statistical theory right, which it's an interesting point.
Yeah, where it goes, who knows, but definitely a good sign, and the market is reacting positively to the data and the direction of where we can see things heading in the US, which is great. So,
yeah, and I don't think that it's, and I think this is probably the interesting point, is that the share market is preemptive. And so a lot of people think that, okay, we've had a month of 8%, the market's going to rally, the market's going to, do well. But what is happening in this scenario is that we haven't seen overly positive news from markets. We haven't, we're talking about inflation coming down. We're talking about, some potential rate cuts next year. We're talking about really stability is kind of what the market's reacting to, is that we're entering, or the market is factoring in the fact that we may be entering into a more stable time. And it's preempting that growth of 8%, which is why the market has shot up as a result of it.
Positive lead from the US, which is great. So I guess now let's turn our attention to what's happening locally in the Australian market. Andrew, the S&P 200 not experiencing as much of an increase as we're seeing seeing in the US. It'd be nice, but what are we looking at? 2.59% for the last month.
Yeah, 2.59% in the ASX 200, which is again great. I mean, considering that Australian stocks as well are never going to move. Not never, but are less likely to move as much as what the US stocks do, because there's also a very high dividend policy in Australia as well. So factoring that in, we are still looking at, and again, like we talk about, 2.5% in a month is, an annualized close to 30% return, which is a very, very solid month. So not to downplay that at all. But we did see the Australian market reacting quite positively as well.
Yeah. Turning our attention to unemployment. So unemployment has risen by 0.2%, which takes the unemployment rate to 3.7. So look, depending on how you view this or how you take it, the one of the things that we need to do in Australia in particular is increase the unemployment rate. So that sounds kind of counterintuitive, but there is a sweet spot for the economy in terms of how many people are looking for work. At these numbers here, they're still far too low. Too many people are employed. It causes a whole range of issues. In particular, businesses can't get their hands on workers. If they're desperate for people, they pay more than the person down the road does the same thing, and it boosts wages. And unfortunately, where we get to is it creates inflation. So seeing unemployment rise is a positive, and I think there's more to go with it. So hopefully we see not huge jumps in this number, but if we start to see gradual increases, that's starting to, I guess, have the impact of the desired effect with increasing interest rates, which will stem inflation.
Yeah. I mean, to kind of, and exactly what sort of you're talking about, Bills, is the number itself only really looks at, one or two numbers. There's employed or unemployed. There's no middle ground or anything like that. And so one of the interesting things with this is you look at that number and it suggests that we've got a very resilient labour force. But there are some early warning signs of some potential weaknesses in there as well. So in that, there's also the number of people that are working part-time, or the proportion of people that are working part-time has increased, which means that if someone's working part-time or full-time, they're still regarded, or that same as employed in the unemployment numbers. In addition to that, youth unemployment increased to 9.2%. So we're starting to see some pockets of weakness in that employment data, which ultimately is really what the RBA is pushing towards. That's what they're trying to do.
It's what's expected. Yeah.
So not necessarily a bad thing. I mean, not a good thing if you're one of those people that are unemployed. From an economy standpoint, it's kind of what we ultimately want to see.
Yeah, and from a business's perspective, I mean, if you think about it, if you're a business owner and you perceive that you're heading into more difficult trading conditions, one of the things that you might do is you might, if you can, is you convert, say, your workforce from full-time to part-time, because it's more flexible and you can deploy people, deploy your people and your team up and down to match the demands of the market. So if you're changing people from full-time to part-time, like you said, it has no impact on the unemployment number because they're still considered employed. So that one there is probably just a natural occurrence of what we're seeing with a slowing economy because of rising interest rates. So they all tie in together. They all go hand in hand. It's what the RBA is expecting. It's what the economy needs in order to slow things down and bring inflation back under control. An interesting one, though, we're seeing youth unemployment has increased to 9.2%. So that's always a tough one because, younger people starting out in the workforce, wanting to get into their careers, doing that's always a difficult one.
Yeah, absolutely. But we have seen a result of, what happens when you've got historical low unemployment. We saw wages accelerate by 1.3% in September, which is massive. I mean, that was a record number. In addition to that, in conjunction with that, we've seen the annual growth rate of wages increase to 4%. And this was at 3.6% in quarter two, which is very significant. Yeah. I mean, we've often talked about, particularly when you're talking about property prices, the rate of property price growth versus the wage growth. And in Australia, we've almost had not an issue, but we've had a lagging wage growth, and this period has really, for employees, has increased significantly the amount of take-home pay that they're taking down. there were some, and looking into these numbers, there was some significant portion of this was also from EBAs, so government workers, where their EBAs had kicked in, and that represented a significant uptick that was just, overnight, because it's not, something that happens slowly and progressively, but still a very significant impact to, wages and growth in wages in the last quarter.
Yeah, that was the increase to the minimum wage, which is really positive step in the right direction, and also for the aged care workers as well too. So both of those sectors impacting a lot of people, or the aged care sector, healthcare sector impacting a lot of people, and for people on minimum wage, boosting that up. So yeah, it is a spike. What that then looks like after that data sort of washes through, are we going to still see this? But it was similar to what I was describing before. From a really simplistic perspective, if you're a business and you're looking for staff, you can't find them, you increase your offer, it increases wages. As a result, you need to sell your goods and
inflation.
Yeah. As a result, you need to increase your prices that you're selling to your customers in order to compensate. Inflationary in nature.
Yeah.
So look, hopefully we're starting to see the leading indicators, what we were describing before, heading in the right direction, and then a lagging indicator, which is the wages. Hopefully we see that start to taper off as well too.
Well, you'd first need to see unemployment tick up a bit further before you see wages start to taper off as a result.
That's right. Andrew, property prices.
Yeah, property prices. We saw some data coming out that we're seeing price levels rise to post-COVID levels, and so what we saw post-COVID was property prices hit record highs, purely as a result of, as a result of a few things, but we just saw the property market going absolutely bananas. Since then, and with obviously interest rate rises, we saw property prices start to soften a little bit. And some of the data coming out now is that we're at, the levels of where it was just post-COVID, where we saw the peak of property prices, which is still very interesting considering the fact that we've seen so many interest rate rises. I know that supply is still an issue in the property market, and there still isn't, the supply levels, particularly in spring, than what we've seen in previous years. But regardless, it's proving to be a very resilient asset class.
Yeah. Look, Australians, interestingly enough, we've got a fascination with property, and that's been the case for, as long as I've been alive anyway. But who knows if that continues. But look, everything that we're pointing to is showing a resilient market. There are, obviously pockets and markets within markets as well too. Where my mind sort of goes with this is with the supply and demand issue. So obviously Australia has been pushing a fair bit for migration at the moment. So we're seeing and hearing numbers about large numbers of people migrating to Australia, which is great. For every, on average, 2 people that come to Australia, you need 1 house or one accommodation. So if you look at that data just purely on a supply and demand perspective, you've also got the building sector that is in trouble and is struggling. So we're not building enough dwellings. So if you look at it purely on a supply and demand perspective, not necessarily affordability, our property market should continue to stay stable and actually continue to grow.
Yeah. Look, some of those are going to be renters, so you kind of equalize a portion of it out, because a lot of the people that come into the country as migrants either can't afford or aren't allowed to purchase property, and so they end up renting, which again fuels sort of some of the rental crisis issues that we're having at the moment. But you're absolutely right. You talk about the fact that we've got an undersupply of property just in people not selling, but then in addition to that, people not building because builders are having their own troubles, and it paints a picture of the property market looking rosy.
Mm-hmm.
But it's very important to caveat this as well. We still are yet to fully see the impact of the interest rate rises.
Yeah,
we're still yet to see the full impact of people's cash flow and people's budget.
Mm-hmm.
And so it's still a bit of an unknown beast in terms of what direction or how that's going to head, in either direction. And so it's important to very, very much take a balanced viewpoint. I don't think that anyone can profess that they know exactly where it's going to go.
I mean, look, one thing we know for certain is the rental market is still under pressure.
That's very likely to stay the same. I mean, most people that we're talking to, that's not going to change anytime soon.
Yeah.
That's definitely got a run rate. But yeah, and that will naturally push up prices as well, will have a positive impact on prices because investing becomes a more attractive proposition as well. So you may see more investors come back into the market. It's interesting. It's a very interesting one.
Andrew, that's why we're not economists, right? Because
Exactly
you could take one stance to kind of paint a picture one way and then take another stance that's completely opposing. But
well, that's why we should be economists, right? Because you can just take stances on both sides and you're always right.
Is that just a fancy way of saying something with enough conviction that it sounds believable and stuff? But
exactly.
No, all good. So I guess look to tie a bow on this and to shout out to some of the airlines out there and things. We're looking like a soft landing is more and more likely. So let's just unpack that slightly. We're talking about being able to land the economy without going into a recession.
Yeah.
That's what we're talking about, right?
Yeah. More likely, but still a risk.
There you go. Andrew, well said, well summarized. Thank you for another episode. To our viewers and our listeners, I hope you got a whole heap of value out of that. Thank you for joining us. Andrew,
look forward to catching you on the next podcast, Bills. And if you like the episode, like, subscribe, and we'll see you all on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.